Hi everyone. Okay, here we go. So yeah, this is the craziness of my first Bloomberg chart. But what I want to show you really is, try and get that big. Okay, great. Let's all get started. Now I'm quite interested to know your thoughts. Just bear with me one moment. Sorry, I've had some problems today already on my machine, but they seem to be fine. Right, so let's get started. And right, let's get started. Okay, great. So sounds okay. Hopefully you're seeing now my chart as well. Now let's take a quick look. Let's just be current. And because we've just had this new piece of economic data, and let's see what the euro is doing on the back of that. So as you can see, it fell very, very sharply, but it had backed off those highs actually all morning as we waited for that data. And this is a fairly good, view of really what can happen before important economic data like inflation. Now, inflation is even more important for the Eurozone right now because we are leading up to Thursday's ECB meeting when they may cut rates because deflation is becoming a threat. So what you do tend to see, so this starts from about 7 o'clock, this sell-off, and it was, people were pushing it higher. The minute it got above 131, all of a sudden the sellers came in. They were potentially, some of the reason for that was that, oh hey, 131 has been the top of the recent range, that's why I want to get out. Some of the other reason was actually pricing in a weaker than expected inflation reading from the Eurozone. The market had expected 1.6%, it got 1.2%, very, very weak, lowest level since 2010, but actually there were a few clues for those who watched closely that suggested maybe we could see we could have actually seen some weakness. Or we could have seen some weakness in the inflation report, notably coming from Germany. Actually, they had very, very weak, very, very weak inflation earlier this last month, sorry. So this month actually, in April. So you saw that. So hence why we had that initial knee-jerk reaction post the report that was out just at 10 o'clock. That's why I was a couple of minutes late. Just had to inform our clients about this. But then we pushed higher, and we got to, we had a nice bounce once we got below 130.50, and that is largely because we've actually priced in this week inflation data for now. For us, I'm just going to go back to my other chart. Just bear with me one moment here. But what really I'm trying to show you here is that we're trading in a range, and I don't see us breaking out of that range until we get this ECB meeting. So let's just look. This is the hourly chart. It goes back for the past, since the middle of of April, really, the last couple of weeks. As you can see, the high there has been 132. The low just below but around, let's say 120. It's been 129.80. Let's say 129.50. But actually, what's even more interesting is that over the last few days, or over the last week or so, the range has narrowed even further, and it's kind of we can't really stay above 131.50. Whether or not, let's just go into the daily chart to see this. Whether or not we go this way or that way will depend on the ECB meeting. Now, for those of you who look at our research, let me just send you some. I'm just going to put something up on the chat, which is just a link to our research page. Sorry, bear with me one moment. And what you'll see on that is a great report, which I think some of you will find really useful. I know a lot of you maybe hear a lot about positioning. What is this positioning going on? Well, this report is all about kind of positioning, how it's measured, where it comes from, and let's do this here, and where it comes from, how it's measured, and kind of what it you know, what it means for FX going forward. And it's worth taking a look at that report because, you know, positioning is definitely sensitive to fundamental events like central bank meetings, etc. It can give a steer on how the market may react post these events. And what we do is we get the CFTC data every Friday for the previous week. So the market is actually short euros, but they did, so the market's short euros anyway, and has been really since the end of January. But we did actually see an increase in those short positions on the back potentially of growing expectations the ECB will cut interest rates later this week. And that suggests two things. So what that means is that the market's already expecting an ECB rate cut. So if they do cut rates, downside may be limited. Now, we may get below this 129.50 level. We could even get to the 200-day moving average, you know, below the 200-day moving average, maybe even to kind of 129, 128.50 level. But we do think the downside will be limited, and we may not get down to the March lows below 128. Likewise, we might not get down to, like, you know, the 126 level that we saw at the end of last year. Instead, what we may do is, if we don't get a rate cut, we think the upside could be higher, because that's not what the market is now positioned for. But you can read more about this in my report, and please do. I hope you find it useful. But do let me know what you think about it. So the next thing you know, this is kind of what Eurodollar's doing. I mean, you know, you can just see when things trade in a range, it's actually quite easy, I think, to trade. Like, I know some people don't like it, but you know, this 132.10 area, it's like a double top. If we get above there, we think that could trigger more buying interest, potentially around about to this 134, 135 level, this level here. And let's just stick a fib level on this for one moment. Oh no, that's not. Sorry, that's just actually that's quite nice because that is a really nice channel there. But let's just put a fib level on this. And as you can see, that is also, that 132.50 level also coincides, 132.10 level, sorry, also coincides with the double top that we see there. Now, there's just one thing I just need to do. I do apologise, guys, but I just need to just bring up Forex.com's disclosures for you, that the information and opinions in this report, they're for general information use only, and they're not intended as an offer or solicitation with respect to the purchase or sale of any currency or CFD contract. All opinions and information contained in this report are subject to change without notice, and the report has not been prepared with any regard to the specific investment objectives, financial situation and needs of any particular recipient. Futures, options on futures, foreign exchange and other leverage products, they involve significant risks of loss and they're not suitable for all investors. Don't forget as well, increasing your leverage increases your risk. Spot gold and silver contracts, they're not suitable. They're not subject to regulation under the US Commodities Exchange Act, and contracts for different, so CFDs, they're not available for US residents due to regulatory reasons. Okay, sorry about that. I forgot to do that at the start, but hopefully you find that useful now. But basically, you know, this 132.10 level is a huge level. It's a 50% retracement of the down move that started in February, ended at the end of March. And if we were to get above there, then we could easily see again 133.18, which is a 61.8% retracement, and then just this resting zone here between kind of 134, 135. Remember, the Eurozone probably doesn't want to see a stronger euro, so we do think that, again, gains will be capped. But let's say, for example, they do start, you know, they do what they've said they'll do, that they will cut interest rates or do what the market expects. Well, I know this is a very messy chart, but right now, levels to watch, 131, and even if you just note these down, these are just levels that I want you to know about, want you to watch. Even if you just write them down, it could be useful. 131.08, that's a 38.2% retracement of the down move. The other level, of course, is 129.90, that 200-day moving average, which comes in around 129.59, and then, of course, 127.67, which was that low. But we don't think we're going to get down to that low at below 128, not in the short term anyway. Okay, let's move on to a different cross. I think I've looked at euro all we can. I'm going to take a look at dollar yen now. Dollar yen has been an interesting one. The dollar index really has lost its groove. In fact, I'll show you a chart of the dollar index now. When it comes up, yes, this is the dollar index chart. So this is the dollar against its largest trading partners. Now you can trade this actually with us, but as you can see, very bearish development on Friday after that weaker than expected Q1 GDP. It fell below its 50-day moving average. Now it has found fairly good support here at 82 actually, and could potentially kind of bounce back, but very stiff resistance now at 82.45. So it is the fact it fell below that 50-day moving average is a slight bit of concern. Suggests momentum has really gone in euro at the moment, and we may need a fundamental driver. Now, of course, we have tons of fundamental drivers going forward, so you can't bury the dollar right now. But I think people were going to be a little bit cautious on it, especially since we got that weekly close below the 50-day moving average, because we are leading up to payrolls. Now that happens on Friday. Long and short of it is, if we get a strong payrolls number, the dollar and the dollar index could rebound, could get back above that 82.40 level, head towards 83, so the top of the range from 2013. If we don't, and we get another weak month of payrolls, people are really going to start worrying about the outlook for the US economy. That for us is going to be bad for stocks in the short term, and also bad for the dollar in the medium term, because it basically means that QE is going to be here for a longer period of time than we first thought, and we may even get below this double bottom here at 81.78. But that is a very stiff level of support. So this, of course, what the dollar index is doing, what the dollar is doing on a broad-based basis, has a big impact on dollar yen. And basically, after last week, we got a very neutral stance from the Bank of Japan, which was completely expected, of course, because they had just done, a huge amount of stimulus earlier in this month. But it certainly didn't help dollar yen get to that 100 level. This is the daily chart. As you can see, 100, it's always going to be an enormous level. And what we saw last week, and you can see that on the report, the link that I sent you, is a huge level. When we got towards it last week, people started selling. So it's a profit taker, and that will make it just harder to get over. So it means what it suggests to us is that in the absence of any major fundamental data today, for example, we're going to drift lower. But obviously later this week we do get big fundamental data. Of course, we get the FOMC tomorrow, even though we only get a statement from them. But if they sound quite supportive of QE still, then we might get below this 21-day moving average, which is the blue line on this chart, comes in around 97.65. A daily close below there is actually quite bearish. Suggests that we could move kind of back to the 95 area even. However, we could get a lot of volatility in this cross because of payrolls as well. What I'm basically trying to say here is that we're kind of trapped in a range. We're still moving higher. The dips have still been fairly shallow, but volume was very low in dollar yen trading last week, and when that happens, it really means there's no conviction one way or the other. It also, when volume is low, you're unlikely to get above major levels, so you're unlikely to break above, say, the 100 in dollar yen, because it just suggests that the enthusiasm for it's not there. So what we potentially may see is what we need is some type of fundamental event to really drive that volume higher, get us above that 100 level, and we think it will happen. If we get above 100, then where do we go from there? Now, I may be a bit premature, and I know that we've spoken about this before, so those of you who've joined me in the past, but what I do want to show you is this. Because a lot of people, everyone's concentrating 100 in dollar yen. Well, what if we do get an amazing number on Friday for payrolls? Where do we go after that? I just want to show you a couple of ways of looking at this really. And let me just look at this. This is, and some people could say, oh, it's data mining, but basically this is a monthly Ichimoku cloud, and the top of that comes in at 120. So 100.20, that's the top of this green cloud around here. That is going to be a very stiff resistance zone, but also if we break above there on the back of the strong payrolls number, that's what everyone's going to be targeting. It's not actually 100, it's going to be getting above this cloud, because once you're above this cloud, this is a multi-year significant up move in dollar yen. Now, we've been above this cloud before, but we haven't been above this cloud since 2007, since this area here. So that would be an incredibly bullish development for this cross. So it's not just everyone's talking about 100, but we could get to 100.05 and then pull back. It's about getting that daily close, especially a nice weekly close above 100.20, so the top of this monthly cloud. I think that's the level where people will get excited. That could also generate oh, let me just check that link. Someone just said it didn't work. That should work. I just it worked for me. Just bear with me one moment. Oh, and I'll let you just look at that for one second. That should work. Otherwise, you can go to our website and find it on. It works for me actually as well. So maybe you didn't copy all of it, Ron. So if you just check it, it should work. Jeffrey as well mentioned that Japanese data has been quite good. Indeed, it has actually. It's putting a lot of pressure now. The strength of some Japanese data is actually putting a lot of pressure on, potentially other central banks to follow the Bank of Japan's, very stimulative efforts. Oh, let's get out of there. We don't need that. On that note, let's take a look at the pound. Oh, which is let's take a look at pound dollar. Which is, another one. Look at that fantastic pullback yesterday. In the last week. Basically, on Thursday, we got better than expected GDP data from the UK, and this really pushed. The pound loved it. It broke out of the top of its recent range ahead of 154. It's now, it's been running into a little bit of resistance on its way to 156. 155.5 has acted as very good resistance, but it does look good. And I think during these kind of rebounds, there's two things to notice, right? So what we've seen is a nice down move at the end. It looks now like below 140, below kind of this low here, which is kind of comes in around 149, is a short-term low. Well, short to medium-term low in cable now. So when you see these kind of down, trends don't last forever, of course, and that was a long one. It lasted the best part of 3 months. You've got to look for levels, levels whereby you may falter. After you get trends, what you tend to do is move sideways for a bit, maybe see a reversal of that trend, and that's what we've seen in cable. So really, where we go from here, we've got to look at, I think it is quite useful at this stage to look at things like Fibonacci retracements, because people will be looking at them. 155.80, that's a 50% retracement of the down move from the start of this year all the way through to March. That's going to be a key level, and then above there, kind of the 57.5 level. That's the key thing. Jeffrey's mentioned a good thing about correlation analysis between the Nikkei and dollar yen. I mean, my argument would be that my argument is that the Nikkei could be very overextended, actually. So I'm not sure that I would use that directly as a correlation. And actually, if you can just stick to what I'm talking about here, just about cable first, that would be really appreciated. So these are some levels to watch. Obviously, we do have some big economic data coming out of the pound, coming out of the UK later. But also remember, as we get closer, we've got PMI data, sorry. But as we get close to this kind of 55, 80-ish level, 158, 156, sorry. That could be very sticky, especially as we head up to payrolls. The pound was the real driver of this cross, and UK economic fundamentals were the driver of this cross last week. Well, this week, it could be more from the dollar perspective. Now, Jeffrey wanted to look at euro sterling. As you can see, euro sterling actually was the most sold last week. So euro sterling was the most sold. Archimed has just said, will the ECB cut affect cable? Well, it shouldn't really. In fact, the ECB cut, if we do see a cut, as we said, we think downside in euro is probably fairly limited. We may see a knee-jerk reaction in euro sterling, which could boost cable, so it could help the pound versus the dollar. But overall, no, we don't necessarily think so, and that's because we think, if anything, the rate cut will be quite small, just 25 basis points. So what we're seeing here is that we've gone through our 100-day moving average, which comes in at 84.35, just below 84.50. it's a bearish development for sure, but we are sticky around this level. Now, below here, this could certainly attract some more selling interest, potentially down to this 200-day moving average here at 83.35. So a good 100 points away from where we are now. Obviously, with euro sterling, it's going to be, it's going to be very sensitive to, the ECB meeting that's coming out. Usually we get an ECB and Bank of England meeting on the same week, on the same day normally, but we don't this month. This month the Bank of England have it a week later. So it's just the ECB on its own. I think that's really going to be the focus. And obviously, if they deliver the goods, maybe if they deliver more, if they're more dovish than expected, then we could easily get down to that 100-day moving average. But there is a lot of support, of resting support on the way down here. But as you can see, very nice kind of, move lower. Some very, a very bearish pattern emerging there, with, consecutive negative days lower. This is, there's, added to that momentum, certainly to the downside. Let's just pull up the RSI just to see where we are on a daily chart. As you can see, yes, nice slope lower. We're not quite in oversold territory yet, which does suggest that maybe people, as we head closer towards the 84.5 level, we could actually see a bit more selling interest. And kind of push lower through that. Okay, the next thing, does anyone actually want to look at anything in particular? I'm aware that there's only a couple. So Jack just said, what is the directional bias for dollar at the moment? Tech and fundamental down, dollar Swiss is down, dollar yen is down. Okay, Ron, sorry, Jack, I will answer your question. Ron, if you just go to www.forex.com, then you can find it there. I'm sorry if it's not working for you, and the link is correct. It should work. So here you go. I'll just do this. And you should be able to find it under. You'll be able to find this under market analysis if you hover over that and then go to comprehensive research in the middle and live market updates. That should get you there. Okay, Jack's just asked about the directional bias of the dollar. Well, as I showed you just earlier, just with that dollar index, as you can see, very development. We got below that 82.50, but right now we are stuck in a range. So I'd say the directional bias of the dollar right now is neutral. I think that will change by the end of this week because we have payrolls data. Basically, payrolls data last month, so for March, was weaker than expected, and that actually pushed it down a bit. And you're totally right. Like dollar Swiss and dollar yen, they've been coming under a little bit of pressure. Dollar CAD as well. In fact, dollar CAD, I just want to show you because I kind of think maybe the closer we get to the bottom of that range in dollar index, around 82, people are going to start buying. People could potentially start buying the dollar. So, like here, we've seen dollar CAD sell off, but 101 is a massively psychological level, very important, and we think it's going to attract some buying interest, as you can see there. Other than that, if we do slip below 101, some buying interest could come in around this 10070 level, which is the 100-day moving average on the close. Very good resistance there at 102. So just watch out for that. And I think, for me, Jack, the directional bias can be neutral until the fundamental picture shifts and it moves us one way or the other. The way to think about it, I think, and it's not because I don't want to give you a directional bias, it's because I don't clearly see one at the moment. I do think that, there's a lot of confusion in the US at the moment from a fundamental perspective, which is making it hard to call the dollar one way or the other. I think in terms of euro dollar, the key thing for that will be the ECB meeting. But I also think this week's Fed announcement, whether or not they're still really committed and wedded to QE for the long term in the US, likewise with the labour market report. For those of you who, maybe aren't as familiar with some of this fundamental data, that labour market report is probably the world's most watched economic data release and has a huge impact. It's the first Friday of every month, so it's definitely worth looking at there. Ahmed has asked about Aussie. Yeah, I'll happily look at Aussie. Again, this, Aussie kind of again just sloshed about just a little bit. Just bear with me one moment. Next week we have the RBA meeting. It's all just a little bit, it's all a bit up in the air about which way the RBA will go. But this is kind of definitely being helped by the fact that it's got above its 50-day moving average, which comes in at 103.50. We're just testing there now. If we can get a nice kind of move above there, then it could get us to kind of 104, maybe even 104.20 in the short term. So right now, if we can stay above this 103.50 level, or even kind of, move back towards, say, 103, if we can stay above 103.50, then I think we've got a good chance of getting up to kind of 104.20. But overall, I think this pair, again, I still see it drifting. I mean, look, there's a really nice low here about this 102.5 level. 102 is now massive, massive support. Of course it is. I mean, look at it. It goes all the way back to kind of July last year as a key support level. It held again, and we've moved higher. This is, yeah, you're right, there is a bit of a daily doji. However, it's not fully complete yet, because obviously the UK session does actually come in and trade this. So I'm always a bit cautious of looking at the dojis at this level. But I think we have, as doji is a perfect example of indecision, and the market's just taking a breather, and that's normal around about some key resistance levels at like the 50-day moving average above there. Obviously 104 is a key thing. So I wouldn't necessarily, Jeffrey, I think you're maybe just shooting the gun just a smidge, but good point, good, great to get your view as always. Okay guys, I've gone over my allotted time. I am going to be oh, sorry, Jeffrey, you meant the previous one, right? Do you mean kind of this one around here? Or anyway, look, maybe around about the 12th of April. Yes, exactly. So that was around there. Again, it was kind of it was definitely it was very much a precursor to a bit of a reversal, but also that 102 level, massive support level going back. So it would have taken a lot for the bears to push us below there, especially without any fundamental data to back it up. Okay, everybody, thank you so much for joining. I hope you found this useful. As I said, if you are really interested in this, I do have a book out. It's called Kathleen Brooks on Forex. You can't miss it. But do look at our website and do join us next week. It's always good to hear from you. And yeah, thank you for your comments.